Be careful of the free cash flow yield indicator. Let's just quickly go through how it is calculated. Free cash flow yield is free cash flow divided by enterprise value. And free cash flow is obviously cash from operations minus capital expenditure. But cash from operation also includes working capital changes. So in other words, is the company investing in inventory and accounts receivable, or what changes have occurred? But during the corona lockdown, inventory and accounts receivable ran down substantially. Just think about it. These companies were getting paid. Maybe they didn't produce anymore. They sold less, but they still sold and they weren't producing, so their inventory went down. And also, because everybody didn't know what their future was going to look like, they completely stopped capital expenditure. All these three factors, or probably more, led to free cash flow increasing substantially in most of these companies. I'll give you an example of a company we recommended in April in the Quant Value newsletter. It's a German crockery and cutlery manufacturer called Villeroy & Boch. And as you can see at the bottom right of this, just look at the bottom right arrow, you'll see that changes in working capital. There was a little bit of cash generation, investment, a lot of investment, then a little bit of cash generation. But look at the cash generated in 2020 from working capital changes as inventory and accounts receivable went down. I don't show it here, but capital expenditure also went down substantially. And you can clearly see it here. Here's the free cash flow yield, or free cash flow per share divided by share price. 3.6 times, which is obviously extremely low. If you take the 5-year average, it was 14.4. So remember, this number is included in the 5-year average. So this number was probably even higher, say 15 or 17. And then if you look at free cash flow yield, or rather the inverse of it, enterprise value to free cash flow, you'll see latest year 2.4, whereas on average it was 9.5 times. If you exclude that number from the average, probably 12 times. This is one of the factors we look for when looking for undervalued companies in the Quant Value newsletter. Obviously, there's 3 other factors in the QI. We'll get to that later. But the stock, nevertheless performed extremely well since April 2021 when we recommended it. But just be careful if you just use free cash flow yield as a valuation measure, because obviously that's going to turn around in the next year as these companies start producing. Working capital is going to absorb cash. Maybe they'll spend more on capital expenditure, and the free cash flow yield will go down substantially.